The Nifty heat map on your screen, it's largely down and about 15 odd stocks are higher. 35 stocks approximately are in the red this morning. So 23,570 or so is where we're starting. Surabhi.
Okay, let's talk about the movers and shakers, and it's all about IT, and TCS has sparked hopes across the sector, really. When the large titan is talking about a pickup in discretionary spends in many of the big verticals, well, the others have a similar fate. 4% up on TCS, Tech Mahindra 3.5% higher, Infosys 2% higher, Wipro, HCL Tech. It's literally IT to the rescue all the way. The problem, however, is that now banks are not playing ball. The bank Nifty is down about 0.25% right now. Let's look at what the biggies are doing. IndusInd Bank is the one that's seeing the maximum pressure, down about 1%. SBI is also on the lower side. HDFC Bank is very flat. Let's see. If HDFC Bank decides to go green, then things can really turn. ICICI Bank is down 0.25% as well. So that's the two large pillars of the market. Other than that, positivity would include BPCL, Dr. Reddy's, Apollo Hospitals, and Sun Pharma. So it's a bit of an IT and pharma and mourning, at least as of now. Reliance is sitting at the flat line. Let's see. Will it go back to its winning ways? We just had that one green day on Reliance this week, and then it fizzled out. Let's see what happens. But on the downside, apart from some of the banking names, weakness comes in the form of Hindalco, Tata Consumer, BEL. By the way, Britannia Lever. Yeah, yesterday's FMCG sort of rally has completely fizzled out this morning. It's not sustaining. ITC is also slightly lower. So these are the early indications. FMCG is down. Banking is negative. It's IT that is seeing the bulk of the buying, 34 points up on the Nifty.
Well, just one quick word on, Tata Elxsi. That was the one that opened up with a cut, I think, of around 7.5% that we spotted in, in pre-open. But that's recovered considerably, actually, from the day's low. So it's up 2.5%. We'll see whether or not it's a trading pop or, in fact, that one as well could see a bit of a recovery. KPIT Technologies, because of this weak set of numbers, the street sometimes extrapolates that. So that's why that stock is under some pressure. A couple of other notable losers from the broader markets. You have Apollo Microsystems, one of those big moves that we saw in the past week. He said he likes that name. That one's opened up well in the green. And we have that story that's come in from Sapna that we'll get her in just a bit. She's talking about the Petroleum Ministry is seeking 35,000 crores for LPG under recoveries of OMCs. And the cash compensation sought from the Finance Ministry can be in tranches as well. So some of these OMCs have popped up in trade, Surabhi.
Okay, I'm looking at ONGC. Let's just go back to the ONGC rate. It's down a little bit. Yesterday was down almost 3% or so. And Oil India was also decidedly lower yesterday. Let's pull up the Oil India rate this morning. We'll get to the Sapna story in just a bit. There is chatter that there is some subsidy coming in for the oil refining and marketing companies. Now, the question is whether we go back to the old ways of ONGC footing the bill. That is the bit of a concern at this point in time. So we'll get Sapna in on it in just a bit. Oil India is flat as of now, not doing too much. So those are some of the early indications that we have. What else? In the mid-cap arena, the color is red. There's no taking away from that. RVNL, Aircon, Union Bank, NBCC, GAIL, BEL. It's been a really bad week for PSU stocks, by the way. The PSU index itself is down about 4.5%. With this cut, it could be almost 5% now. But PSUs have been absolutely out of favor, and that trend is continuing this morning as well. I think we'll get to Andrew in just a bit. Andrew Holland is our market master this morning. Actually, I think we do have him now. So let's straight away get to the conversation then. Andrew, hi, good morning. Season's greetings to you. Wish you a very happy 2025. Now, it's not been a very happy start to 2025 for Indian equity investors, right? They're keeping the faith. They're, continuing with their SIPs and their mutual fund inflows. But this foreign selling has been really difficult, and it's showing no signs of stabilizing. What do you make of it?
Well, I think we spoke about this before the new year, actually, in terms of I think foreign portfolio investors are going to wait now to see what President-elect Trump does. In that respect, you've seen the dollar rising, bond yields rising in the US. So therefore, there's no real need to kind of jump into emerging markets until you can see clearly what these policies might be. I think you're kind of in that kind of, is it going to be more shock and awe in terms of what Trump does, or is it going to be more tempered in terms of the the kind of the policies and tariffs that is being rumored to be implemented? So I think a lot of people are just sitting on the sidelines saying, if there's any market rally or there's any kind of risk which is being played through the currency markets, then if you feel that the earnings season is not going to be so good, the budget might not come to the rescue, then valuations remain quite high. So I would have thought that's just an easy risk off the table kind of trade, which foreign investors are making at the moment.
Oh, okay, all right. So that remains a risk, Andrew. We take that point. But then the other issue is this debate about a slowdown here in India and earnings, right? What do you make of this? And actually, let's start with IT, because that's the silver lining that we've got. TCS sounding pretty optimistic in the last 12 hours when our colleagues did the interview. Can IT be a bit of a pillar for this market?
Yeah, it can be. Listen, when markets fall, the safe havens are usually FMCG, IT, and pharma, and that's probably what we've been seeing more recently as well. So the TCS results were below expectations, I think, for most analysts. But the commentary was strong, as you mentioned, or positive. But that doesn't mean that the whole IT sector is out of the woods. But obviously, they have tailwinds in terms of the currency at the moment. So that will probably keep the positive kind of views on the sector. As regards the economy, we've been the RBI is still too high in its forecast. I think GDP is probably trending more towards 6%, and that means that earnings have to be downgraded. And I think that's what the market's trying to adjust to is lower earnings. Not just for this year, but expectations going into 2025-26, where we're thinking that EPS growth will be maybe between 5 to 10%, but let's say 10% more optimistically. So therefore, the index could rise along those kind of lines in 25-26. But all of this is irrespective of what we're thinking regarding Trump. But when Trump comes in, all of this could change, and I think that's what the market will have to grapple with. Not just our markets, but global markets as well. So sitting on the sidelines having cash, I think is a good strategy just for the very short term.
Okay, sit on cash. Cash could be a position in this sort of uncertain times. Hi, Andrew. Good morning. Good to see you in. What about the Indian markets? When you joined us last time around, you said at these valuations, at these levels, you're not very, very excited. And the US market's the main game in town, with Trump taking over. We are a little bit lower in comparison to what we spoke, when we were in November itself. I think we're around 5 to 6% lower in comparison to those levels. How much lower for you to get excited on the Indian markets?
So I think if the market was to fall another, say, between 3 to 5%, I think valuations will start to become a little bit more compelling. Listen, we'll get into oversold territory. We probably are in the bank index at the moment, and you could see bounces. But if your expectations are that forecasts are going to have to be lowered as this quarter unfolds, then 3 to 5% is probably what I'd be expecting anyway in earnings revisions. So that would be in line with the market fall as well. So at those levels, I'd be a little bit more optimistic. But there's no real catalyst, right? Unless the government starts spending money, which it doesn't seem to be opening its purses at the moment, then there's no kind of multiplier effect going into 25-26 for the economy. And therefore, you're seeing a lot of more negative reports about either a K-like kind of recovery and consumption, or big slowdown in capex. So all of these factors, I think, are just playing into the negative views where valuations don't support you.
Yeah, no, absolutely. Point taken. I'm just looking for anything which is moving in a meaningful way. So yeah, I mean, it's all actually the leaderboard with volumes is all dominated by IT services, TCS, Nifty, LTI, Mindtree, Coforge, Wipro, Persistent, Tech Mahindra, and so on and so forth. Keynes is making a bit of a move higher, 1.5 higher. And then there is something like an Amber, which is up about 1.25% as well. Can't see Dixon anywhere. at least not with volumes at this point in time. Andrew, hi, morning. The entire renewables space, if I've spoken, I don't know if you've spoken about it before, or if you have a view. Solar especially. Now you've got more than a few listed players out there. Anything you own, do you have a view out there?
No, not really. I think, in terms of the whole kind of renewable sector and power in particular, we know expenditure is going to be there. So we know it's a long-term play. But, I don't think there's any real catalyst, again, for these shares to move higher. I think it's going to be a little bit more competitive in the short term. So staying away. I think what we're trying to think about, Prashant, is where will currencies and where will bond yields go in the short term? Because that, I think, will give us a good idea of what global markets might be facing in the kind of first quarter of this year once President-elect Trump takes over. So I think that will give us a good clue of where foreign investors will also be will they be coming back or not? So, for example, if, say, the China tariffs were not 50%, but 30%, I think that would be good for emerging market sentiment. And if China was to throw in some stimulus as well, then again, flows would start coming towards emerging markets. So these are the things that you have to watch out for. At the moment, the dollar index is telling me that's not going to be the case. But as I said, it could be a more tempered approach by President-elect Trump than the market is anticipating at the moment. That's why I'm saying I think just wait till after the 20th. I think we'll get some clarity on what his proposals will be. And as we've probably seen in the last few days, they can include countries as well as tariffs.
Absolutely. We don't know Greenland, Canada, tariffs, who knows what's coming. And the 20th of January is just the start. We must remember, right? It doesn't end. There's no crystal clarity by the night of the 20th of January. We're on a roller coaster here. And Andrew, we will look forward to having you back with us on the roller coaster in the coming weeks as well. Thanks very much for joining in. Have a good Friday. Okay. Well, the market has kind of settled out now with the large caps doing better than the mid caps. By the way, there's a deep cut in the mid cap market, and that pain has really extended. Early in the morning, you've got a 1% decline on the mid cap index, while the Nifty is okay, thanks to the fact that, IT is still contributing. But this screen is now telling us about the broader pain, which is still existing out there.
It's breaking down, right?
Yeah.
It's very, very clear.
Structure is weak.
Structure is weak and gains are not holding. We're absolutely now flattish. Look at the Nifty Bank. And that has been the weaker of the indices. It's basically broken all key support levels and it's down 200 points now. That's about 0.4% knock, 49,296. And as Surabhi pointed out, the broader markets are also now starting to roll over. That was not the case so far. 400 stocks are higher and about 1,900 stocks are lower at this stage.
And Prashant, just one more point. You have the Nifty Bank that is struggling today.
Yeah.
And all of last year, you were blaming it on HDFC Bank. Today, you can't blame it, because HDFC Bank actually is holding one end up. So, and that's the largest constituent in the Nifty Bank. And that's actually holding mildly in the green. So, it's X of HDFC Bank that is seeing some kind of pressure. But with the kind of selling that you're seeing on the Nifty Bank, it's due for a big bounce. Just because of the one-way move that you're seeing. 51,500 a few sessions ago, we're at around 49,000 odd. So we're due for a bit of a bounce. Let's see whether or not we get it today or we get it, sometime next week. But we're very much due for a bounce, particularly on the Nifty Bank, and that's been the underperformer.
But all through last year, we were talking about how foreigners are not coming or foreigners are selling, and that's why banks are not performing, particularly HDFC Bank. Now we've come to a time when you wake up in the morning and you'll find some brokerage or the other talking about how the best for banks is now behind, now EPS cuts are ahead. This morning it was Goldman Sachs saying that expect more EPS cuts and margins have peaked out. We have not even started the beginning of the next credit cycle. And then, you have so much of chatter coming through and then,
credit growth was running at 18-20%.
Yeah.
Now it's 5-6%.
Exactly.
So that's clearly, there is that slowdown, which is very, very evident out there.
Absolutely.
But let's talk about the oil and gas space as well. And our colleague Sapna is joining in. Sources tell us that the Petroleum Ministry is seeking 35,000 crores for LPG under recoveries for oil marketing companies. Sapna is joining in. She's been reporting on this story over the last couple of months. Sapna, over to you. Morning.
Morning, Prashant. So, yes, absolutely right. This is the amount that has been sought, though it's being indicated that the under recoveries by the end of the financial year could be higher because CP Saudi, that is the benchmark for gas pricing, those prices have been elevated the entire 2024, and now with the winter onset, that elevation could actually continue. So, despite the under recoveries being higher than what has been sought. This is what is the expectation, at least from the Petroleum Ministry. Now, OMCs are, have been seeking this kind of support. If you remember, if you recall when the Q3 results had come out, this was one of the major pain points due to which their earnings had been impacted. So 35,000 crores is what has been sought. Given to understand that this money that has been sought, the cash compensation, this could also be in two tranches. So if you assume that the entire amount will be okayed by the Finance Ministry, and that could be an indication for the coming budget, maybe not, in principle, the full amount being okayed, but the flow of the cash compensation coming through in tranches is what we have been given to understand. So assuming 35,000 odd crores is where the buck will stop. IOC being the largest, more than 50% will go to IOC and the remaining will be shared between BPCL and HPCL. We'll have to wait and watch and see how this pans out. There's another element to this entire thing. Given to also understand that when the OMCs received the compensation previously for during the just when the Ukraine crisis had broken out, around 28,000 crores they had sought and 22,000 crores as cash compensation was given by the Finance Ministry. Apparently, there was also a demand of GST on that amount that had been given. So this time, the government is likely to calculate it in such a way that the entire 35,000 crores accrues to the OMCs and there is no tax liability on that side. So that's the second aspect that we'll have to look at. Of course, we'll have to wait and watch and see how this pans out, if anything comes at all in the budget or not. But 35,000 crores it is, as of now, being sought by Petroleum from Finance for compensating OMCs for the LPG under recovery.
All right, Sarna, thank you very much for that. That's an important story. We will continue to put the spotlight on. Well, let's move on. Markets, of course, struggling a little bit, down about 15 points. But let's talk about the real estate space. Now, we've been kind of putting the spotlight on real estate as a space over the last couple of days. And, we've had real estate consultants. We've had a couple of companies join us over the last 48 hours or so. And, everybody's been kind of pointing to maybe the first signs of some slowdown as far as residential real estate sales are concerned. Remember, we've had a fantastic boom in the residential real estate segment, especially ultra-luxury segment. Remember, according to Anurok, and we put this data out earlier as well, 59 ultra-luxury homes worth some 4,000 crores were sold in 2024. Value terms, it's about 17% on top of what we saw the prior year. But let's get some perspective from a very large real estate player. Abhinandan Lodha, chairman of the House of Abhinandan Lodha, is joining us here in our studios. And we'll also have Santosh Kumar, Vice Chairman of Anurok Group, with us. Gentlemen, great to have both of you here in the program. Abhinandan, good morning. Great to see you here in our studios. And I think we are speaking for the first time maybe in this program. So, pleasure. Just that point, Abhinandan, it's been fantastic. First of all, let me tell our viewers actually that Abhinandan Lodha Group is the largest branded land player in the country. Right? So you focused on the land side, you don't sell flats.
Yes.
You sell plotted development, real estate in that sense. So the actual stuff. How has 2024 been? Just a bit of background, and tell us how is 2025 and beyond looking. It's such an important sector. Real estate per se, and that got fixed a few years ago, and that sort of showed up in so many other places. Now we are starting to hear the first signs. Maybe some slowdown is emerging. Your thoughts?
No, I think generally the real estate sector, as you rightly said, has a very large role to play in the economy. And it is also almost incongruent to the economy in that sense. I think 2024 and the year precedent to that, both were quite exemplary years. For example, the House of Abhinandan Lodha have started development activity on the plotted land side only in 2022, 2021. And I think what we've seen over the last 2.5, 3 years is sustained demand rise across the country. We are now present at 11 locations across the country. So it's not that you're seeing more in urban area or less in rural area, right from Vrindavan to Neral to Konkan to Ayodhya ji, there's great amount of demand everywhere. I don't see at this point of time any indication of a slowdown coming out that segment. in general, there is I think some conversation around the super luxury segment having seen a lot of buying. I don't see the demand there coming down as well. I think what might have happened at this point of time is that the supply in some of these places, which was very, very clearly visible, say 3 months ago, of under construction properties, there the prime properties may have already gotten taken up. So I think the super premium buyers may be waiting a bit on the sideline to see new supply coming in. But in general, I think the demand for real estate will see a significant uptick over the next 2 to 3 years. While pricing may move from region to region, in general, the demand capacity absorption at this point of time is quite high. The demand continues to rise. As the economy does well, people make more and more money. The desire to participate in housing also increases. What we are seeing more and more on the land side as well is that generally people have recognized that land is equal to wealth.
And we'll come to land in just a bit, Abhinandan. Just to complete that point, you said economy is doing well, people do better and better. That's the trajectory over the longer term. But we are struggling a little bit now. I mean, growth has come off a little bit, 6.5%. More importantly, stock markets, which has been so important, at least, and I've put that to many real estate developers. How much of this boom in real estate is being fed by this boom in stock market, because so much wealth has been created there. That has also kind of tapered off a little bit last 6-8 months. So just tie in those two aspects as well.
And Abhinandan, if I could throw in one more data point that we picked up this week as you give us your answer to this. Like Prashant was saying, we spoke to a bunch of consultants earlier as well. Knight Frank gave us a data point and that really stuck in my head. And that was a data point for Mumbai particularly. What they've noticed is in the 50 crore plus 100 CR super luxury premium housing segment, things are still fine. But what they told us is that in the 20 CR to 50 CR bucket, houses worth this much, that's where in Mumbai there is already inventory worth 5 years, which is already there. That's the stock that's already there. So could that be a bit of a worry, coupled with what Prashant is saying, that stock markets are now far more muted?
So I think it's a mix of two things. If you look at this months of inventory concept, it's a great concept. But if you go back 3 years in time, people were under the belief that we've got almost 10 years worth of supply under construction in Mumbai at a given point of time, which very quickly moved from 10 years to less than 18 months. The 20 to 50 crore rupee segment, I think if you go back 12 months before, you see most of the supply got announced only in the recent past. So while it seems like a lot of supply today, you will see a lot of absorption happening over the next 2 to 3 years, where again you'll see a supply-demand mismatch. Generally, unless and until FSI norms change, oversupply situations are very, very difficult to create in urban areas. So wherever you've seen oversupply situation actually getting built in Mumbai, that was probably when you had the FSI changing from 1.33 to upwards. Now with the uniform DCR already out till 2034, people are reasonably aware of what is the possible building which you can create. So I think on that perspective, if you date that back to the announcement of supply, you'll see that the supply-demand lag is very indicative of the fact that people will now start picking up this inventory because they've now probably reached a stage of construction which makes people comfortable to buy.
So you don't see any oversupply in the Mumbai market?
Not at this point of time, no.
Okay. Just on the stock market relation and the point. 3 years back, by the way, Abhinandan, I was just looking, Nifty was at 15,000. It's not a direct correlation, but you know what I'm getting to.
Yeah.
What's your sense? Is that the wealth effect, right?
No, I think the wealth effect definitely has an impact, especially when it comes to the absolute upper end of the market. What I really don't have an understanding of, and probably you would know much more, is that I think a lot of money has already gotten made, and people have not necessarily taken that money off the table. And what my limited experience tells me is that when people feel that one asset class sort of maybe plateaued for some time, people tend to take money out of that asset class and put it into the asset class where they can either use or they can see the next level of indication, uprise coming. So I think from that perspective, while people have made significant amount of money over the last 2 or 3 or 4 years, I don't think too much money has already been taken off the table. There is a sustained amount of retail money coming into the country. So at the upper end of the market, as people sort of start encashing their gains, you may see actually one more wave of the upsurge coming before at any point of time you see sort of momentum going sideways.
All right, Abhinandan, since we're just talking about markets, real estate as well, I just want to put this question across before we go to Santosh. Plans of listing?
No time soon.
No
time soon.
Not yet.
Not yet.
No. But in the next few years, that could be the ultimate plan?
I would hope so, yes. I would hope so. I think as the business reaches a maturity, we would definitely like to take part in the value and also create value for all our stakeholders, but not in the near future.
So maybe in the next 3 years or so, that could be a 3-year plan?
That could be, yes.
All right. We'll come back to you, Abhinandan. Let's get in Santosh Kumar, the Vice Chairman of Anaro Group, who joins in as well. Hi, Santosh. Good morning. Thanks a lot for waiting by. Well, what's your take? As you've mentioned in your note, that 2024 was a super year for ultra-luxury housing. How are things shaping up as of now? Initial feelers that you're getting for 2025 and how you expect the year to shape up?
Yeah, like Abhinandan mentioned, Prashant, the Indian real estate sector, even in 2025, is poised for a robust growth. Primarily because there's a stability, there's a favorable demographics, and also there has been a lot of government reforms. And we do expect, in the forthcoming budget, we see there should be some positivity for the real estate sector. With the GDP growth, even though the projection is for a little bit of lower growth this year, but urbanization and demand for both the residential and commercial continued to sustain that momentum which was there in 2024. So we believe that this will continue even in 25. And like Abhinandan mentioned, stock market growth, some of the the businesses which have been really doing good, the startup ecosystem is really pushing the demand. The money is coming in, and some of the government initiatives are also supporting the demand for the real estate sector. And there are different emerging sectors like co-living spaces, warehousing, data centers continue to drive the investment opportunities.
Got that, and fair points, Santosh. Abhinandan, so let's come to what you do, land, right? I mean, we're talking about residential real estate overall, but is owning land as a concept? I mean, for the longest time, it was a tough thing to do. You had to have access. You needed. I mean, only wealthy people with connections, access could think of buying land in some far-flung place where you're not. I mean, proximity was very important. As you've showed over the last 3-4 years, that is not really the case. You're trying to do something different. Tell us, I mean, what are the trade-offs between owning land versus, actual real estate, and how's it looking?
So I think in terms of the underlying value creation in real estate, I think land is really where all the value gets created. And I think an indication of that is the current redevelopment boom in Mumbai. So there's somebody who's willing to take over an existing building, give the tenants more space, and still create value for himself by creating extra saleable area, which all comes out of the fact that as urban limits change and as cities mature, FSI norms change, locations change, and land becomes more and more valuable. And I've seen all my life, and I think maybe most of us have enough stories around us, where people who've sort of invested in land and were able to hold on. Imagine holding on to an acre of land in Thane or Gurgaon 20 years ago, and the value creation is created today, right? And I think
Nigel would be on an island somewhere.
And I think that the fact is, I think the Indian psyche recognizes the value which land can create. And most of the people who unfortunately were not able to access land due to the issues around possession, title, ownership, how do you keep it safe, how do you get approvals, and how do you resell? So I think what we've managed to do is we've managed to build our entire business on the back of a tech platform, where till date we've not had a single in-person consumer interaction. Across the 11 locations that we are present today, every single piece of land that we've sold has been sold across the screen. And what that enables people to do is it's almost like buying dematted land. You're sitting anywhere in the world, you believe that Vrindavan or Shimla or Mumbai is going to do great. You got now access through somebody who's got credibility, and he's sort of assuring you on title, possession, approvals, and resale, all 4 of those things. And because of that, what we've seen is the kind of buyer profile which is now coming in. 27% which people buy are buying from outside the country. 70% of the people buy from outside the state where you're launching, which was probably effectively impossible till, say, 3 years ago. And that juxtaposing essentially means that as long as you got a view on India, I could be sitting in Hyderabad, and I understand now that what happened in Hyderabad 4 years ago, where I've seen the real estate boom, maybe missed it, is now going to happen in Nagpur because of the kind of development which is happening there. And I don't need to physically go to Nagpur and try and buy a half an acre piece of land. I actually now have access across my screen. As long as I take a call on the macro environment of the country and the micro environment of a particular region, access is getting created and people are wanting to participate in land like something we've never seen before.
A very, very interesting point you're making out there, Abhinandan. But tell us, if you had to pick out the most promising market, which one would that be?
I think Vrindavan offers fantastic value proposition at this point of time. From a cultural tourism perspective, great luxury has not come there. The amount of people wanting to participate in land there is extremely high. And Shimla does the same as well because there's no supply in that place. So if you're able to get on supply in a region like Shimla from an investment perspective, I think Vrindavan, Shimla, and then I think Ayodhya ji's got a long-term story playing out for the next 10 years sustainably. I think between these three places, if you're sort of able to take a bet and investment and wait patiently for 10 years, you'll see the kind of return which Gurgaon or Thane have created for most people.
So Vrindavan, Shimla and Ayodhya.
Yeah.
I wonder where's the land left in Shimla. I mean, you start climbing up that mountain, all you see are houses, but there is. I don't know where the land is. But just to complete that point, and it's very interesting that you brought this up, I just want your thoughts on the way the overall industry is growing. We've got REITs, now we have smaller REITs, but these are entities which will be looking at annuity-based returns. So they'll be looking at commercial spaces or, maybe, specific aspects like data centers or warehousing, which Santosh also said. So when it comes to more individual ownership of land, do you at all see REITs playing a part, or will it be independent developers like yours? I mean, how do you see the industry evolve in terms of real estate as an investment asset class, something that financial planners have always been advising against because it's fraught with risk, it's high capital, and there's just too much at stake?
No, I think I've seen a lot of my wealth management friends sort of talk of having real estate in your portfolio, but they refer only to apartments. And I think apartments, while you can take some exceptions out, have given sort of single-digit returns over the last 10 years on a sustainable basis. I think land returns are fantastic. So I think if you're able to provide that comfort to people, a lot of people would be able to participate in land. And I think it is not the real estate investment cycle will have sort of co-investments happening. I think you'll have fractional ownership taking place. I think you'll have people participating in REITs, but they will probably be, I would say, larger in size. And I think land will become a far more important horizon on the investment cycle. I think at this point of time, less than 2% of the investment in real estate moves to land. And that number will significantly change over the next 5 years.
Well, that's only for the big fish. Let's actually bring in Santosh's view on this as well. Santosh, do you concur? Do you see more broad-based ownership of real estate assets and land? And also, will it be only reserved for the ultra HNIs, or do you see this coming down the curve?
Oh, I think majority of the developers now coming out with the smaller plots, which definitely attracts the smaller investor. I think the outlook for both land and developed property is promising. Land continues to be a valuable asset, especially in the urban peripheries and tier 2 cities. Like Abhinandan mentioned, where developers are actively acquiring land parcels to meet the rising demand. Investment definitely comes with some of the risk, but growing trend of institutional investors focusing on yield generating assets like office spaces, retail malls, but the plots and land continues to give them the higher return as compared to developed properties.
Right. By the way, Abhinandan, when we talk about returns, asset classes, we always look at Sensex. What has gold done over 20-year bonds? But land, of course, it's all because it depends on what you buy, where you buy, right? But in any sense?
I think in general, if you're buying land from a 10-year horizon, and I think this is evidential data I'm happy to share with you, in any semi-urban to urban area of the country, if you're able to hold on to land for a 10-year plus period, you'll make 24% plus compounding return.
24 CAGR.
Which is by far the best return you'll see almost in any asset class. The idea is how do you ensure you hold on to the title and the possession of the land and make sure it is being bought with the ability to maximize after time.
Wow. By the way, we're already getting queries. Please ask Mr. Lodha where in Maharashtra.
Where in Maharashtra?
So we are present in Khopoli, Konkan, Neral. And
That's looking good?
Yeah, I think Khopoli is a great belt. I think from the value proposition it provides today, especially for somebody looking for consumption-based buying. So, sort of you buy a piece of land today and that also is large value creation land, right? So what we've seen is people are able to buy in Goa a piece of land at 5,000 rupees a square foot. they are able to hold on till delivery. They can sort of build a bungalow on top of that at 6,000-7,000 rupees a square foot. And then the resale is at 30,000 rupees a square foot.
Oh.
So the value creation which land does in the mid-term actually comes by change of usage. What it does in the long term is by change of FSI and change of city norms.
I must say, being a journalist, I must put on the table the caveat here that you must know your own risk appetite, right? It's not for the faint-hearted. It's not, you can't liquidate suddenly if you need, your maybe 50 lakhs back. Or can you? I mean, you're saying that it's all becoming screen-based, but quick question, ticket sizes and ease of liquidity. Ultimately, it's a hard asset.
30 lakhs to a crore is the general ticket size which we deal in.
Okay.
So I think from that perspective, it's quite okay because leverage is available as well.
Okay.
And I think resale today, at least on our platform, we are able to provide resale to 98% of the people who put it out for resale.
Oh, wow.
Okay.
Because people, like you said, have different risk appetites. So some people want to buy at the start of a cycle.
Yeah.
Some people want to buy when the cycle is completed.
Okay.
All right. We'll leave it there. Abhinandan, great chat as always. Thank you very much.
Thank you so much.
Look forward to our next one. Santosh, thank you very much for being with us here as well. So that is real estate in focus. And, we were talking about money moving, and Abhinandan made that point. Maybe, that one, not last push, but maybe there is this one wave which is left as markets start to, realization sets in that maybe one asset class is starting to consolidate a little bit, won't go boom, boom. Maybe some money will come out and perhaps, look at other opportunities, etc. I mean, case in point, 100 points lower this morning on the Nifty, 23,420 is where we are at. Surabhi?
And this is not just, we've of course broken the earlier lows of this week, we've broken last week's lows as well.
Yeah.
So the slide is just, it's
so the December 31st
relentless.
low was 23,460 and now that is gone. So 23,416 at this point in time. We'll take a quick commercial break, more sort of in terms of stock spotting on the other side, but we'll also talk about another interesting space, which is of course EMS. Keynes Technology Management will be with us to talk to us about how 2025 is looking like. Stay with us.
Any kind of bounce is getting sold into, and that's evident on the screen. The Nifty is at the low point of the day. The Nifty Bank as well tried to stage a bit of a pullback. We are holding around that 49,000 odd mark, but those bounces are getting sold into. So as of now, that dip has not got bought into. And one stock that we had highlighted earlier today was KPIT Technologies. Tata Elxsi is seeing a lot of selling pressure, and KPIT Technologies as well has got a little bit, the investors out there are a little bit nervous because of Tata Elxsi, which belongs to a similar space, has come out with a big set of numbers. So that's why that's down 4.5%. Let's focus on a couple of other themes then. EMS, that's the important theme out there. And some of these stocks have seen some selling pressure. This after, Tata Electronics has got the CCI clearance to acquire majority stake in Pegatron India. What does this mean in terms of competition? Will the intensity go up? Well, we're joined by Mr. Jairam Sampath, the Director and CFO at Keynes Technology India. Hi, Mr. Sampath. Good morning. Thanks a lot for joining in. Wishing you, as well as your team, all the best for 2025. The theme in terms of EMS is sounding very, very interesting. However, the markets are a little bit nervous that there could be additional competition coming in there with the entry of the Tatas. What is your take? Do you believe that the pie is big enough for everyone to get into, or do you believe that this will pose some bit of a challenge?
Anyway, good morning, and thank you for having me on the show. Fundamentally, anybody interested in the industry and putting up new ventures is a positive sign for the industry. So market and the pie was already large enough. It was just that the foreign players were taking a huge share out of this, and then Indian domestic players were probably not participating. So now that trend has kind of reversed, and you have a lot of people in India trying to partake from the import substitution, let's say, trend. And so it's a good thing. Also, in a marketplace, you need to have many players, especially world-class players, always welcome, so that India as a destination for manufacturing gets recognized. And that's very important because there are only small differences between companies across the world in terms of their abilities. So it's the attention that makes a lot of difference in terms of making you kind of ready for attention from the OEMs and so on, and the RFQs. So nobody does a complete census survey of market before they award contracts. So they go by a top level understanding, and then they shortlist a few players and so on. So it's very good news that there's continued interest for investments into India across the various sectors.
All right, Mr. Sampath, so just clear the air. You're saying a new entrant actually could be healthy for the industry, and you don't believe it's a risk because the pie is big enough. Are we getting that correct?
Yeah, absolutely.
Okay, all right. So that we take that on board. But there could be an element of pricing pressure, more amount of players. If you have a client, they may want to go to another one. Could that be a possibility, or do you think that pricing power exists for the industry?
Yeah, so pricing pressure, pricing is a function of demand versus supply. So the margin pressures, as people imagine, will be higher if the supply is plentiful and demand is less. But in case of India, it's the other way around, especially supply of indigenously manufactured electronics pretty low compared to the demand. And so also in the newer areas of electronics, like semiconductor, advanced assemblies, and so on and so forth. So there are a lot of areas where demand exceeds the supply. There could be government projects and so on. So in such cases, the margin pressures generally don't make themselves visible. So margin pressures have not much to do with the number of players. It has something to do with the nature of the industry.
Mr. Sampath, hi, good morning. Great to have you on the show today. So I just want to talk about now, as an industry, what do you need additionally from the government? We've already seen PLI schemes for mobile phones, for IT hardware. There's a lot of expectation. Our colleagues have also been reporting that this new 25,000 crore rupees PLI scheme for electronics components, I mean, that would be there. It'll cover things like maybe printed circuit boards and maybe camera modules, so on and so forth. How successful have the PLI schemes been so far, and what further tweaks would you want? What would you want to hear in the budget and beyond that can really make the Indian EMS industry fully competitive and make it fully realize its potential?
Yeah, that's a very interesting question. See, firstly, the thing that's required is government must follow through its plan of doing localization of imports. And that, to my mind, government doesn't have to spend too much money. They just have to nudge the OEMs, the global players who are selling into India, to look at India as a base for manufacturing. So it could be varying levels of, let's say, value addition, but that probably will do the trick faster than any other PLI. In terms of PLI and other schemes, I think they are good to begin with. Maybe a first few years of industry setup, they kind of take the edge off the margin pressures. But then eventually, government must make sure that it encourages companies to invest into newer technologies, and it must follow through its plan for what is known as Atmanirbhar Bharat, and especially the emerging areas such as electronics and high-tech manufacturing.
No, so on PLI, I mean, just give us your experience from Kane's perspective. How much have you benefited from the existing schemes and the contours of the new scheme that's being now discussed? 25,000 crores of a PLI scheme for, like I said, for PCBs, for some sort of, other system assemblies, for camera modules. Does this sound good enough? And what about the thresholds? Like you said, the thresholds for localization, maybe they'll be increased. So, how will all of this play out?
Yeah, in certain, let's say, component categories like PC board, I think it is very helpful because we have a very minuscule market share compared to the global players like China. So it will definitely help to move a lot of production into India. And so, like I said, PLI schemes in the beginning stage, especially in these kind of components like PC board and other components, they'll be greatly helping in establishing manufacturing facilities in India. So I think it's a good thing that government is thinking in this direction. And these are essentially, I say, positive moves. Instead of putting just tariff barriers, I think they are going one step further, and then they're saying that if you make in India, you get some little bit of benefit. Our experience has been that the PLI, especially in the industrial production, it does not account for a huge amount of, let's say, influencing factor, because PLI schemes, by and large, are visible. And so while they make the total cost of electronics production in India lower, but they may not specifically benefit one company or the other. So from that perspective, they are more a systemic, let's say, dose of medicine. What I think is even more powerful is to move the demand into Indian, let's say, Indian companies. So by various means, by using the Atmanirbhar Bharat plank, so that will probably do this entire thing far superior, because there are lots of areas where government is a large buyer and also a large influencer. And also, I think we must project positively the future demand potential within India for both consumer as well as non-consumer areas. Our non-consumer areas like industrial and other areas, also penetration of electronics is quite low. So we are actually just in the beginning stage of this entire revolution. As I say, of course, there's always a lull before a storm. So what you see today, as sometimes, there is a bit of a lull because of elections and stuff like that. But let's not get fooled. I think we are in for a very aggressive growth in this particular area. Because that we see from the kind of RFQs that you get and kind of footfalls and the percentage of occupation of our conference halls and so on.
Yeah. All right, Mr. Sampath, we're running a little short on time, but since you mentioned PLI and the government support and the way forward, and you're not shying away from the fact that there's a tremendous runway for companies like yours. But I need to ask you on this PLI aspect. You have Dixon, Foxconn, in the last week or so, we've been hearing about them coaxing the government to please clear their PLI dues. With regard to your company, what is it at? What is the total PLI dues? When do you have to receive it? And have you received what you'll have asked for till now?
Yeah, so we have very small portion, less than maybe about 7-8% of our business wherein PLI is applicable. So from that perspective, it does not hurt us. But I do notice that if you compare the incentive payouts today compared to, let's say, 4 or 5 years ago, it's much faster. But then obviously, if some industry players are coming out and saying, please do pay it fast, I think that also reflective of the fact that in their total profits, PLI is in significant proportion. So I think government can definitely do it faster and set up mechanisms to more upfront these incentives so that the benefit is not lost. So whatever incentives are given much later do not spur the demand as much as if it is given on time. Because if it's given on time, it gets reinvested into the business. But it's given very late, it goes into some buckets, So I think the players are asking rightfully to give this so that they can maintain their profitability and the positive outlook.
Got it. But Mr. Sampath, but have you received what you have asked for till now, or is there a
delay? See, so far the movements have not been bad. We have just in IT products, which is the servers, etc., and then also in some white goods electronics. And it's a very small amounts, and so we are receiving. It's not that we are not receiving. Even in the new projects where there is capital subsidy, there's a fair bit of say transparency and movement of files, etc. So we don't see any major issue here, but maybe it's also reflective the fact that how important PLI is for certain companies. So obviously their let's say levels of anxiety will be higher than companies like us.
Okay, all right, Mr. Sampath, we appreciate you joining in, giving us an industry view out there. We're seeing this tremendous growth, new player coming in there, so there's big potential. And with regard to the PLI, you'll be happy to see the PLI payments coming on time for other players as well for the industry. What's promised should come on board. When we have you with regard post your Q3 numbers, we'll get more details from you on your company. But thanks a lot for joining in. Well, by the way, when we're having that chat with Mr. Sampath, just pull up the intraday chart of the Nifty. We have moved to the low point of the day. We're down 160 points. The Nifty Bank as well is now down close to 600 points. So those bounces are getting sold into, but that's not telling you the picture. Advanced decline ratio, you have only 190 stocks that are advancing as of now. So, a little bit of caution would be warranted at these levels, given the kind of fall that we've seen in the first hour of trade. Slip into a short break, come back. Manisha Gupta will focus on all the commodity-related stocks.
Welcome back. Continues to be yet another tough morning for the markets. Take a look at what's going on. It's a 150-point decline, one-way decline on the indices right now. The mid-cap index has slumped over 1.5%. The advanced decline ratio is extremely negative. Just about 190 stocks advancing, about over 2,000 stocks declining. Very weak. It's a breakdown that we're seeing once again. And barring IT, really, there's nothing else in the market that's holding up. So let's actually go and revisit that silver lining, which was TCS. TCS came out with solid commentary, though the revenue growth was, of course, a bit muted for the third quarter. We have Rima joining in with the 5 reasons which are powering up the stock today. Rima.
Well, the first one is the stock has been an underperformer versus peers in the last 1 year. Taking into account today's rally, in the last 1 year, TCS share price is up 13%, but its other large cap peers have rallied close to about 30%. Secondly, because of this underperformance, stocks like Infy caught up with TCS in terms of valuations. Historically, TCS always commanded a premium for its solid execution, its size, but now Infy and TCS both are trading at 27 times forward multiple. Reason number 3, while Q3 revenues admittedly are a miss, you would still classify them broadly as, inline numbers, and there were no EPS downgrades that we saw. And the fourth and the more important reason is the deal wins were strong and the management commentary was upbeat. The deal wins were in a range of about $8 to $9 billion for the prior 2 quarters. They went up to $10.2 billion. And here the management speak, seeing an improvement around discretionary spends in BFSI and retail. The deal cycle, basically decision making, has shrunk by a few weeks. The current sentiment is more positive going into this year. FY26 should be better than FY24. And even the initial conversations, client budgets have not closed, but the initial conversations suggest a positive bias. And here's how brokerages have reacted. CLSA has upgraded the stock to an outperform. The new target price stands at 4,546. The reason is valuations are now attractive. relative to peers and even versus its own 5-year history. And they're now forecasting a 14% EPS growth for the company in FY26. Jefferies has a buy call, but they say, again, valuation at 27 times is attractive and factors in near-term growth headwinds. HSBC has a hold call, but they do say performance seems to have bottomed out, though they do see some downside risk to FY26 consensus estimates.
Okay, all right, Rima, got that. Thanks very much. So TCS continues to be the support for the market. Not that it's helping too much because there is a wide slide that is underway as of now. In fact, Rima, before we let you go, let's also do a quick check on Tata Elxsi. I mean, Tata Elxsi came out with obviously really weak numbers and the stock's reeling under pressure as well.
Now it's been a couple of quarters of weak numbers from Tata Elxsi. The stock is down 31% in the last 1 year. Last year, it was a big underperformer, and despite a 25% fall last year, it's fallen a little bit more today. And now the 3-year returns have been eroded for Tata Elxsi. The problem is valuations are high for the company at 40 times, but growth is not at a premium to peers. Look at the estimates by the street. For this year and next year, the street is penciling in single-digit top-line growth. For this year, closer to 5%. For next year, closer to 9%. So that's the problem. High valuations when growth is not at a premium. And also, if you remember, just 3 months back, the company said that FY25 growth should be better than FY24. But 3 months later, that's impossible to, it's close to impossible to achieve because in 9 months, they've clocked in a 5.7% growth, less than 10.1% that they had in the prior quarter. In Q3, growth has slowed down. Flat growth quarter-on-quarter, year-on-year growth has decelerated 2%. Margins have missed street expectations, and margins are much lower than the 28-29% that they used to command. And the problem is the transportation vertical in Europe and US, which is about 50% of their overall revenues, that has slowed down. Their clients are facing some challenges. And that brings us to KPIT Tech. Because while Tata Elxsi gets about a 53% revenue growth from the auto companies, KPIT is 100% dependent on the auto companies, and this has also been an underperformer. This stock too is down 32% in the last 1 year. We'll get clarity on the 29th of January when they report their Q3 numbers, but this is also a stock which, growth headwinds are visible. Last quarter, they told us that growth for this year will be closer to the lower end of their guided band of 18 to 22 times, and valuations, though have derated, it's still at 40 times forward multiple. Back to you.
All right. Thanks very much for that. So those are the 2 tech stocks in focus today. IndusInd Bank is also down. The whole market is down. The Bank Nifty is down. But IndusInd has fallen the most today, and that's on the back of Goldman Sachs. Remember earlier I was pointing out about a wider sector note that GS has written. GS is very circumspect on banks in general and IndusInd Bank in particular. Abhishek, tell us more.
While Goldman Sachs has written on IndusInd Bank, they have downgraded the stock to neutral, cut the target price to about 1,090 per share. They have cut EPS estimate by 5%, 16% and 18% for FY25, 26 and 27. So they say that revenue engines have slowed down for IndusInd Bank over the last 2 quarters. They expect that to get further impacted due to rising delinquencies that you are seeing with respect to commercial retail loans, especially the MSME and CVs, and slower loan growth as well. So having said that, they say that the valuations have corrected quite sharply as investors have moved away from price to earning to price to book value multiples due to limited near-term visibility with respect to the earnings trajectory post Q3 earnings. So they say that the stock is currently trading at 1-time forward multiple, that is FY26 price to book value, which seems fair for the kind of ROA, loan growth as well as ROE that they estimate on IndusInd Bank. Back to you.
All right. Thanks very much, Abhishek, for that. With that, let's now move on to the commodity markets. Equity markets obviously are reeling under pressure. Let's see what's happening in commodities. Manisha, what's the news?
Well, I'm looking at the best gainers in 2025 for now, and this is purely because of the impact of rise in US tariffs that the markets are working with right now. I'm talking about silver and copper. So when you look at the previous year, we saw silver prices gain up by 23%, and today is 10th of Jan, and we already are up by nearly 5% for this year until now. But the better gains clearly are coming in for copper. Last year, it gained 6.5%. The first 10 days of January, it's up by 8% already. So clearly the best performer that you are seeing in 2025 2025 till time comes in for copper. Markets are anticipating or betting all-time highs to happen in copper for this year. But to begin with, this is purely an impact of the expectation that the US tariffs will rise. So in last 5 weeks, we've seen 15 million ounces added to the US COMEX warehouses. This is in the anticipation that you will see prices going higher. Well, remember, US is the largest importer of silver, and US does import silver from Mexico, Canada, Turkey, and US is looking to increase tariffs when it comes to Mexico and Canada. So this is exactly a precursor or a pre-reaction that we are seeing into the markets right now. Also, when you look at the LME warehouses, well, they have continued to drain down as well. Remember, it has been 4 years that you have seen global silver markets in a deficit, and with the US buying like it's buying right now, silver absolutely in limelight right now. That's exactly what has been happening for copper as well. The markets are absolutely getting divergent here too. The LME prices in copper gained up by 1% overnight. It's trading at a 3-month highs right now. But that is LME, that is London Metal Exchange. When you look at the US exchange, which is COMEX, the prices there also are trading at a 4-month highs. We've been looking at prices gaining a 1% average every day in all of 2025 till time. So this is happening because the markets are attempting to discount or rather look in to the hefty tariffs that the street is anticipating going forward. So when you look at the COMEX markets right now, when we started this year, the discount was almost like zero. But right now, COMEX is trading at a premium of $400 to LME. I mean, that's the kind of buying or demand or anticipation of tariffs that the pricing is happening with. Also, when you look at the COMEX LME stocks, well, they are at a 6-year highs. They have gained up by 10% in 2 months. This is all because of the more copper coming in for US right now. The markets also are looking at higher imports that continues from Chile. That is where US gets 60% of its imports from. But 19 to 20% of copper imports within US happen from Mexico and Canada, where again, there is a tariff problem perhaps coming in. And we have seen that come in for prices. For today, though, it's going to be about the US non-farm payroll data. That is what the markets will focus on.
Absolutely. And now we are expecting that number to look weaker in December compared to November. Thank you for that, Manisha. With that, we'll take a break. On the other side, our special segment coming up with Lata. Today in Indianomics, she will be talking to a whole host of experts on what next for the microfinance sector. Have defaults peaked out?
Welcome to a very special Indianomics. The default rate at microfinance companies don't seem to be ebbing. That may be part of the reason why the microfinance SRO, self-regulating organization, MFIN, pushed back its new rules that only 3 loans may be given per borrower. It has been deferred to April 2025 from the earlier deadline of January 1, 2025. to get a 360-degree perspective of the microfinance industry's problems, I have with me today an elite panel. Joining me are Aishwarya Khandelwal, the Associate Director, India Ratings and Research, Chandan Thakur, Deputy Director, Sadhan, which is also a self-regulatory organization of microfinance institutions, Sachin Seth, the Regional MD, India and South Asia at CRIF. CRIF is a credit scoring, much like civil. And Anu Jogesh, a special guest here. She's a PhD doctoral researcher from the London School of Economics and Politics. For the last 6 months, has been touring extensively in rural North India, but more especially, she is an ex-CNBC-TV18. 18 years ago, she worked with us as our star FMCG reporter. So, gentlemen and Anu, thank you very much for joining me. Well, let me start with Sachin Seth first. Sachin, if you can lay down the data itself, according to the scoring sheet, have the default rate increased for MFI borrowers?
Yeah, Lata. So, Lata, thanks for having me here. And yeah, I mean, all of us are seeing that stress for last couple of quarters. Mm-hmm. And as per the latest report, GRIF has released just recently, I mean, there is obviously a bit of a stress which continues. And specifically to the numbers, as I think most of the people do have the report, that, when we talk about, loan at risk between, let's say, 31 to 90 days, it is almost 2.8%. And if you take 31 to 90 plus 90 and 180 together, it comes to about 5.2%, right? And that's obviously a bit of increase from the previous quarter. So definitely it continues to be a bit distressed portfolio at this moment.
Okay. Chandan, what's your sense? I guess, 1 minute, Mr. Seth, this number is as of what, October?
This number is as of cut-off September end. Okay. Because obviously the data gets pulled and then get processed and the report gets published.
So your October, November, December data is awaited. Chandan, what's the situation on the ground? Do you think December things improved or they are pretty stressed? Because otherwise MFIN would not have pushed back the deadline.
So thanks, Lata. I think Sachin has already mentioned like the number has increased a bit. But I would also like to highlight a bit like why the number has increased. And in the first quarter itself, a few major reasons. One was like, of course, the general election, the climate issues, the unprecedented heat. And one more thing is that I would like to highlight, even post-COVID, we know like the demand in the sector. I mean, the loan has gone up in terms of disbursement and all. But in terms of the employment generation to pay back the loan, that is still not, up to the mark, even in the rural area. So that unemployment or in terms of the repayment capacity is not as much in terms of the pre-COVID era. Yeah. So that is one of the reasons a bit like the number has gone up. However, we are sure in terms of we are really optimistic in terms of the good Kharif season and some preventive measures has been taken by both the SROs. So things are getting better with every passing day, and we are sure like in the last quarter, like this quarter, in the quarter result will be better in terms of the favorable for the sector. And hopefully from next financial year onwards, we will be back to the normalcy.
Yeah. So, no, Chandan, I was going to ask all of you what you all see as the reasons for the issue. Thanks for starting it off. But you are saying that December numbers, by your guess, would be better than the September numbers. Is that your, I mean, I know it's anecdotal, but is that your guess?
It would be more or less same. I mean, September number and December number would be more or less same.
More or less same.
They were like the last quarter, the March figure would be better than,
so the current quarter you're expecting better. Yeah, I guess we live in that hope. Aishwari, you would have more granular details. Would you say that Q3 would have been just stable or could it have gotten worse?
So I would say, I mean, Q3 delinquencies is expected to peak out in terms of the delinquencies numbers. I think 4Q onwards, we could see some, I mean, the decline in delinquencies is expected to stop now from the 4Q onwards. But the stress in the microfinance sector, we believe is still 2-3 quarters. We expect it continues to stay. The normalization is expected to from second half of FY26 itself. I mean, what we have mentioned it in the report, because if you look at the stage 2 loans, which is 30 to 90 DPD, it continues to increase, which indicates that there's still remaining stress in the sector, which would be coming out in the third quarter results also. So unless this stage 2 loans declines, the stress will continue to be evolved in the next quarter also. Okay. So we expect, I mean, the normalcy in the delinquencies is still 2-3 quarters away.
Okay, I get your point. But what you're saying is that even more defaults than Q3 perhaps will not happen in Q4, but declines will take time, correct? Okay, Anu Jogesh, you were touring in rural India when the news came that MFIN is asking all the lenders to restrict the number of loans to 3 per borrower. Yes. How was it received?
Well, it was actually very slow, but what we essentially saw, what I saw is that even what they call center heads, women who are part of these baithaks, who are essentially, head of the joint liability groups, were also struggling to pay back. These are supposed to be borrowers who have the capacity to pay back well and were struggling. And we heard from loan officers that essentially there were people leaving houses and going away. Likely to try, well, they say absconding bhag gaye hain, but actually they're likely going to be with their husbands who are in cities to try and earn something to come back. Because it's important to note where this money is coming from, what's paying back. And as one of your guests said, it's not rural and farm income that's largely paying this back. It's often, when I sit in these baithaks, it is women waiting on the phone for their husbands who do paint polish ka kaam or do construction work or drive taxis in Mumbai, Bangalore, Pune to essentially pay that money back. And it's literally that interest payment. So kisht se kisht. So interest payment to interest payment, they are waiting for money to essentially come in.
Bringing down the to 3 borrowers is not easy because you're usually taking one loan to pay the premium.
Exactly. You are taking one loan to pay for the other. And if you're not, because you suddenly have a limit, you're depending on your local relationships. So a lot of loan officers call this pipelining, which is, I need money, I've exhausted my number, so I've borrowed in your name. And then I've left you to pay it back.
Okay, so and that's a big social issue. Chandan, what is your sense? Why did MFIN push it back? Would it have been utter chaos if they had stuck to the Jan 1st deadline?
We all know that there are stress, there are cases of over-leveraging, multiple lending and all. Even we had one meeting with all the CEOs with MFI, and we released the Sankalp guidelines also. Where did we and along with all the MFIs, we have agreed upon to follow up, to follow the guidelines in terms of all the due diligence practices, following the household income, following the the credit bureau check and all those stuff. And if you are complying with all the guidelines like FOIR of prescribed by the Reserve Bank, the number of lenders will automatically come down. And with new...
Lekin rule, why was the rule deferred? Did the microfinance guys come and tell you that there is too much pain at the bottom of the pyramid, so please push back the rule? What was the reason for that deferral?
See, the amount of disbursement, of course, the disbursement has gone down. So it takes a bit of time to, to restrict with the numbers with 2, 3 or any particular number like that. Because it's a gradual process. So that might be one of the underlying reasons.
Okay. Mr. Seth, what's your sense? Has the number of borrowers with 4 loans increased in the third quarter?
So, Lata, as we are seeing the trend and based on purely on the data, while we have observed that, the SROs are working towards sort of putting guardrails, etc., or implementation of that, but I think many of the lenders consciously have started doing that. And we are also seeing the improvement of that. So if you see the data we have published, it shows that there is a percentage point, improvement in terms of, let's say, reduction in the number of, so whatever lending is happening today, there is a percentage point improvement in terms of number of borrowers or number of lenders to a borrower is coming down. So which shows that there is a conscious effort being made, and probably this is one of the reasons. And I'm sure if these guardrails are put in by SROs and people follow these guardrails, I'm sure this will have a positive impact. Though the quantum of impact is still unknown, it will only be reflected in next couple of quarters. But definitely this is a positive sign, and this is something which has already started showing benefit.
Okay. Aishwari, you in your latest report, you have a table, and that table will come up. It was flashing even as Mr. Seth was speaking, that the rate of growth of loan outstandings was far quicker than the rate of growth of rural wages, both agri and non-agri. So this is an income problem? Incomes didn't grow as fast as consumption or as fast as maybe inflation?
I think the average debt outstanding per borrower, that also increased significantly over the last 2 to 3 years. Plus, the agri wage growth was not keeping pace with this over leveraging or the increase in the average debt stock outstanding per borrower. Not only the microfinance borrowings, but also the other borrowings also increased during this period. It's only during this current year, I mean, we are seeing that average outstanding per borrower is declining because of the